Hello everybody and welcome back. Well, probably by now most of you out there are aware there's something that's sneaky that goes on in markets, and that is manipulation of the price. How do we find out though how manipulation is being affected and where to place orders and where to of course target in the future? Well, today we'll be breaking down some things that are occurring in the options markets over the next few weeks that I think might interest everybody around the world. Whether you trade stocks, commodities or cryptos, which we'll be looking at in today's video, it has dramatic effects on these markets. So will we rally to the resistance or are we about to go back down? Let's take a look at it right now. See everybody, this will be a great one. Well, welcome back everybody to the daily show here where we talk about stocks, cryptos and commodities and the key levels that we need to be looking at together. If you like any of those markets, always consider subscribing and smash that like button if you find value in today's video. Let's talk about fear and greed. No surprises, extreme fear still showing in the market. The reason? Well, we had 7 weeks in a row down, and that was pretty negative. There were some interesting things occurring though. Although the day was a little bit flat to down and we did see some selling off, we saw 2 stocks standing out, Amazon and Google. Noticeably, 2 stocks going into splits very soon. So suddenly the split trade is coming back through. And I thought a few people in our live stream coming in when we were talking about it, we obviously do live stream every Monday open and this time Tuesday due to a long weekend. We're talking about, is the split trade back on? And I think it could be, and we'll take a look at the stats a little bit later and look at those key stocks. Which sectors were doing well? Well, frankly, not many of them. We had a bit of a sell-off in the morning and there was a rotation back into the SP500 and back into stocks that happened during the retail hour of power. So remember, what Wall Street does, it likes to trap retail into an idea that is a negative concept for the day. Everyone starts to short. Then it places a change of trend, which many people can't spot, and the market ends up becoming a bit of a rally and ends up putting in that base. What you're looking for is react, don't predict. You know, patience is really key in these markets. And I think a lot of you that have been trading for a while would know that the best setups are the ones that you often come in, you see the manipulation, you spot it, and then you react to that. XLY, most interestingly, was up thanks to Amazon and a few others. And this means that, of course, it was a predominant risk-on day in terms of the market was still showing us that it's prepared to take risk at this stage. I know it didn't look like it, but I think by XLY being up, it was showing that it's prepared to take some risk moving forward if we continue to see a rally. Another thing I thought was a really interesting stat just to bring in was that retail have sold their US equity purchases from the last 2 years. That is, most people have been liquidated or at least sold their positions. And look at this switch. What a monstrous switch here in terms of retail orders being placed and retail orders getting taken out. This is the way the market works. Unfortunately, it is nasty and it is really critical to have for your investments a longer term approach and always buy quality. Really the biggest standpoint of time, whether you're Buffett or anybody else, is buy things that you have a longer term outlook on. Otherwise, it's going to be very hard to hold it. And we can see by that chart that retail have been knocked out a lot on a lot of these orders, especially hyper stocks. Let's get into the technical analysis. We'll start off here with, of course, the VIX, the volatility or fear index. It actually dropped again, which is a good sign. Are we underneath 25? No. If we go underneath 25, is that positive for markets? Yes, it's positive because it means that the VIX will gravitate hopefully towards 20, which should mean that further bullishness is present. And once we start to look at options, I think it'll make some sense. Speaking of options, we'll move over to the PCC, put call ratio going back up again, showing us that people started to enter short positions again, that is puts into the market. It's better if the market is going up. So if the market's going up and heaps of puts getting entered into the system, that's actually a pretty positive sign. What tends to happen is the markets continue to go up to trap those positions. At this stage, we're pretty flat. So if you're feeling bullish, you actually want more people to start placing puts. That would be ideal in terms of this scenario. Let's move over to the US 10-year. Now, a lot of people know that this is a very important indicator in markets. Pretty much the market is based on the US 10-year. A lot of people don't understand how important this is to rotation and other things that occur. We saw the long leg dojis. We've now seen a rally that's moved up through the US 10-year. So let's just quickly go down to the smaller timeframes and figure out whether we could be seeing a turn here very soon. You'll notice it's at resistance. So basically this area here has been a zone. And I think behind here is the most important area. I would like to see the US 10-year go down from here. If it goes down and the market starts rallying, again, it's a plus sign. If it keeps going up and the market keeps going up, probably an X sign. That means that maybe you do want to start thinking about that bearish move down happening faster rather than later. Let's move over to the US dollar. The US dollar index was rising a little bit. It rose, came through that level from our last video, and then it's pulled back. At this stage, it looks like the dollar is trying to hold itself, or at least, find some stability. And it makes perfect sense. Why wouldn't it want to hold stability? It's had a massive sell-off. We're back on the 20 moving average here. You'll notice on the 8 hour. And at this stage, it looks still weak. There's no real clarity towards it going hugely bullish. But I could see it consolidating here because it had a massive sell-off. And luckily, as a community, we didn't get trapped by this evil false breakout that trapped so many into thinking that the dollar was so strong. That was super evil. We didn't get trapped by that. We've been short predominantly. I think it's best to be neutral at this stage on DXY from that standpoint, possibly even DXY strengthening. Now, gold was one that broke through a really key zone. So we'll notice here, it broke through the defended area. There were some signs. Really, once it did this, it wasn't very positive once it got through that first little mini defended. There was a great trade on Monday. If you go and look at the small time frames around here, there was a fantastic long. The left on order, of course, would have been cleared up by that particular candle. And at this stage, it's broken through. So I've got two key levels here. I'm still relatively bullish on gold, but one thing I do need to see, US 10-year must come down again. If US 10-year keeps rising, don't bet on gold, that's for sure. That would not be the best idea. I'm telling you that correlation is a real thing here. If we're moving through stuff like 1825 and through to this 1810, both of those levels will be interesting to find turnaround stories. And if we do have turnaround stories through here or here, that could be interesting to come back and buy those zones. Now, another thing we've been warning against is oil. Now, I don't have really any kind of super opinion here on oil in terms of bullish or bearish. If I was looking at this standard chart coming into yesterday, you would have to say bullish. Why I'm negative on it is, again, where it's at, what it's done before, and the structure formation leading into it. I won't go into it too much more than that, but it's mostly a multiple month concept. So remember, if you're trading like a week or a day, my opinion means nothing to this. But I will say that I'm not trusting the oil price at this stage, and I actually would be more bearish than bullish on oil, even though the price is currently, really looking towards that buy side. Be careful here, guys. Yes, there could be a 124. Yes, at this stage, the technicals are making higher lows. There's no reason to say the turnaround's there. But a lot of it comes down to, again, what's going to happen with inflation in the future and whether that's here to stay and it's going to keep spiking up. Remember, if inflation starts to stabilize or drop, that isn't going to be great for the oil price. The other market that's kind of showing worrying signs that we've been talking about is natural gas. So natural gas had the tweezer on it. Of course, we could be much more negative here. And at this stage, it has been negative. Back to the daily 20 moving average, which it's bounced off each time. Breach under here. Continuation of the short. Now, they call natural gas the widowmaker. The reason why, pretty simple. Go out to a monthly and have a look at some of the previous spikes that natural gas is well known for. For anyone that hasn't been around markets, always do the monthly first. Have a quick look and just see whether that stock or that instrument is crazy. Natural gas is wild. It's called the widowmaker because the stress is high. So if you don't like trading it, you don't like high stress, then this is probably not the one for you. But just an example there of that tweezer high continuing to short. Now, Tesla, we cover daily here on the channel. I guess to me, the market's the most important thing right now. That is the SP 500 and the Nasdaq and the DOW and IWM. If they're turning, expect Tesla to turn up. If risk on is on, Tesla will most likely go up. If risk off is off, Tesla will go down. There are some key zones. Of course, that 720 has a gap in it, so that could be something that to watch in the future. And it really all changed here for us as a trading community. That's where we put in that new low, made the max pain, shorted off, and breached the peak. When we breached the peak, the rally began. And at this stage, it looks relatively okay, but I think the market would be the best gauge. And then if Tesla is your pick, then so be it. But it's fighting with this little bit of resistance over here. Effectively, there'll be some orders sitting behind this doji. And that's where the bears are holding it back down. They're saying, no, you will not get past. You shall not pass is what they're saying. If it does pass, though, there's a fairly decent runway upwards of this almost 900 plus kind of price target. So yeah, you'd be surprised how much could be in, the Tesla moving into this kind of range, that 900, 880 high. So I would like to see a breach, a little bit of pullback, and then run, or even a breach, run into this zone. So Tesla could be interesting next couple of weeks. Certainly a lot of volume coming back in, a big one there. Let's move over to Amazon and talk about Amazon and Google. So we know the splits coming up. Splits tend to show positivity. Now, we saw splits for years and years and years having ramp into the split, and then of course having ramp after the split. Interesting. That has been a statistical occurrence. It actually is statistical throughout time. I'll show you in a second. But what happened this year is we had a mixture of a split announcement followed by just horrible data. Frankly, terrible fundamentals. And on top of that, of course, a general market sell down. So what that's done is when the announcement was made, the markets rallied. But they rallied so far ahead of the actual split themselves. So now we're getting closer to the split. We've put a double bottom in. We've got a max pain kind of low that's taken out things. Is this a good base for Amazon and in fact Google? Because we'll bring Google onto the chart just so you can see the difference. Well, they're both quality stocks. You could do worse, of course. I mean, for many people, these stocks are the pinnacle, the best in the market. And I don't blame you for thinking that, especially, Google, Microsoft are my 1-2 favorite. Obviously, Microsoft being my favorite, Google being my second. And let's look at the split data. Well, plus 3 months, that is after these companies have announced splits, tends to be, okay. It tends to be an outperformance. Stock splits tend to do better. Now, of course, you will say, well, that didn't happen this time. Yeah, we had a market meltdown. But after that, check out the stats. It actually becomes even more predominant how well the stock does in terms of outperformance. The stats become even more wide in terms of what's going on here. 13.9 versus 4.4, 25.4 versus 9.1. So as the market ramps, effectively what's happening, or as the split happens and after the split happens, we do tend to get pretty decent performance here. And that's something that I think a lot of people are starting to wake up to, because they announced so early and it's taken so much time that now that we're getting there, it's again a buy the rumor, but now it's buy the rumor and potentially even keep the fact. That's something that is occurring here in this market. DAX, yeah, pretty good. This is the German index, still very strong, breached our first level over here. Very big deal. And of course, got into our resistance and now it's pulled back a little bit. DAX still looking relatively okay. It's gapped up here in the futures. And I think you can see that it's done one of the first things that you'd expect from this current rally. That is breach, create an inverse head and shoulders, and then hopefully now you'd be looking at it to go that distance with issues around that 15,000 kind of mark. Hopefully it happens. If it does, the rest of the markets will come to our key levels. Let's now quickly move over to the IWM. So we'll talk about the Russell 2000. This hit kind of a level that was a little bit worrying. And I think bears will probably like this one the most because they'll say, okay, well, IWM pulled back this much last time. Obviously, this was the false break, trapping liquidity, grabbing all those orders. Over here, we've got very close to that pull up. Now, IWM is at a point. I've got this boxed for a reason. This is an area where I expect weakness to come back into this market. And certainly IWM was shown last time to not only ramp early, because remember it ramped on 24th of Feb and didn't come back so much, but it also turned right at the same time. Sometimes the Russell 2000 small caps can lead. So think about this time. We've used this to help us find the bottom. The 12th of May was much earlier than the rest of the market made the low. It didn't come back and make a new low like the Nasdaq and the S&P did. It actually started rallying. So we'll watch IWM very closely here, both as bulls and bears at the moment, to tell us whether this market is sick or not. Let's find out. And yes, it could be very sick, but right now we're not seeing the signs of weakness. Let's look at the Dow. The Dow came back to kind of a nice little reversal level, found a lot of strong buying off this zone, and Wall Street, of course, picked that up. We kind of targeting this area in terms of this is where a lot of resistance, a lot of supply has been before. Tons of orders behind here, no doubt. And I could see the market moving in here. And it comes back to our greater thesis with the options that we'll talk about very soon. Let's move over to the Nasdaq. Downward trend, technically broken up. Are there gaps? Yes. Could these gaps get filled? Absolutely. Would I have levels sitting on them? I think you'd be remiss not to think this is possible. And the market comes back down and tries to fill that gap at some point, whether that be in the future where it does something like this later on, or whether that be soon and it goes like this. But this area will most likely be defended by bulls. And at the moment, the markets are still quite strong. You have to expect some pullbacks. I mean, this market went, let's just look at this last run. From here to here is 10% without even a decent pullback, like a little puny pullback. So 10% is no joke on an index, and that's a significant move. Now, we are targeting this gap hopefully in the future. For the perfect kind of bull bear scenario to work out, it would be what's happened so far, the max pain down here, that is the level that trapped everyone into thinking it's short, reversal at this point, little bit of consolidation, rally in, this is the double bottom, the double bottom's take profit target is here, fill that gap, and then we find out who wins, the bulls or the bears at this area. That's at least the longer term target. Let's move over to the SP 500 and have a look at that though. Nice little pickup here. And there was a trade in this area, and we'll just quickly talk about it in a moment, just so you can see why following the trend, even on the small time frames, pays off. So let's say you had a bullish tinge to the market yesterday. Well, you can't just go, oh, I'm going to buy any level possible. You have to say, well, how about let's react and let's not predict? That's a big thing that I'm teaching in the mentoring at the moment. If you're interested in that, links in the description. It's a big thing that I'm teaching in the private community. You can always join that 7-day free trial in the links down below. And it's because it's true. If you look at anything like dollar cost averaging, obviously you're just buying key levels and you're just basically investing with that strategy. Yeah. But if you're trading, you need to be kind of precise. And the best way of being precise is seeing what the market's telling you. That is, where is the reaction? Where is the market telling you that things are changing? So again, there's a gap here on the S&P 500. We also have a little gap in here and possibly here. That's why we've got those zones targeted. And in the previous session, we talked about the ES futures. And basically what we got in the live stream is we had like a zone sitting around the bottom around here where we expected the market to possibly start to try to turn. So where did it actually turn in the last trade? So if we actually go over and we think about what happened here, let's just quickly price it out. Remember, this is a 1 minute chart, so you could do a 5 minute just to see it. We've got a trough, so we have a peak, trough, lower peak, lower trough, lower peak, lower trough, lower peak, lower trough, lower peak, lower trough. And then we change in here, actually on the small time frame on the 1 minute. We create suddenly a higher peak and there's a max pain here. This is where everything switches. It actually all starts in this particular area here. And if you understand what you expect at that point is the market will come back down, grab liquidity, and then try to make that ramp. And at this point, it's defending this zone. So this area here is all defended. Effectively, at this stage, that's one of the most important areas for the bulls and the bears. They're fighting it out in this little box. So in the future, this is a very important box to be checking out. But it all changes here, and the whole day changes from being all short to starting to go bullish. And as you see more and more timeframes confirm and go up and up and up, you can be more comfortable in the fact that the bottom is in and it looks like it's going to ramp. So if we're looking at a market like this right now, you'll notice it's fighting it out up here at this 41.67 area. There's a fight going on there on certain timeframes. And if it breaches that, things are looking much better towards the bullish run. So I think this is a very important zone in the next 24 hours. Obviously, we have this defended area that's pretty important. And if we breach these types of zones, where are we looking towards? Well, trying to get that gap fill in. So these are the types of things you start to look for in the day trade. If you like this stuff, let me know in the comments down below, and I'm happy to bring all of this concept in. I like the long term, I like the short term, and bring it all together. But just let me know what you guys like as well. It's very important. We always listen to the feedback here on the show. Let's talk about options now, because I said we would, and we'll bring that into the markets. So we already know that 429, 4,290, 4,300 on the SPY is a key zone. This week, where are the options? Well, there's a lot sitting low, way too low for us to care about. There's a few sitting at 400, and there's a decent amount sitting at 420. So there's a lot of calls floating around 420. So it would make sense for the market to try to hold below 420 for the options expiration. It doesn't have to happen because it's not a predominant week, but it certainly would make some sense. And this is an ever-evolving thing that you want to check daily. The next thing, though, is the third week options expiration. So a lot of people don't know, but the third week is where all the big volume is. That's where the true options lie. the 3rd week expiration, or of course, if you're looking at witching and quad witching, you want to look at those quarters as well, and definitely subscribe to the channel because we'll be going through that in a lot of detail moving forward. So where are all the options lying on the most important expiration for June? Well, funnily enough, there's a ton of puts. Look at all the puts. They're everywhere because these are left over from all of the negativity that people had on the markets recently. Now, would Wall Street really want to pay these off? And a lot of people say, Tom, how do you know Wall Street's not in there doing these shorts? Well, they were, and they've probably closed some of their orders. Plus, there's also hedge strategies that go on all the time. But predominantly, who buys a lot of options? Retail traders. Who sells them? Market makers, the banks, the participants in the market. They sell them. Do they want them to options expire worth money? Ideally not. So you'll notice there's 2 big strikes here. And we have kind of zones that are starting to form. We've got that 430. We've got trapped orders that are sitting here from a long time ago. Those calls aren't going to make any money, guys. And then we've got tons of puts. So you'll notice that probably something like 430 might start getting bigger and bigger and bigger. And the more it gets bigger, the more likely that is a very key point coming into the expiration on the 17th. If we look at the options here, we'll notice max pain sitting at 425, which means that if Wall Street had their way, they would expire options at 425 right through that point on the 3rd week, the most important expiration to be looking at here. It's a little bit early to be looking here, but still it's important. And that is where they would like the options to expire. So as this number shifts, which it will shift coming into it, we will always want to look at how many of these are open still. Is this getting bigger? And is this number rising or declining? And these types of things can help us get a bit of an understanding of where those market resistances and supports are. Bring that back to your TA, and it can help you quite a lot. It can also confuse you if you're not knowing when to use it, knowing not. So yeah, definitely watch the channel. So hopefully we can break that confusion. Let's move over to the crypto market here and look at it. Hey, I tell you what, this Bitcoin, it's fighting with the orders, and the bulls and the bears are scrapping it out. Good news, Bitcoin shorts, that is BTC shorts, continues to decline. So 32,000 becomes still a very key zone, and kind of what I expect is 32,000 to get breached. I would expect rallies. Maybe it just goes ballistic. Sometimes it does. Possibly still a pullback, maybe back down to around that 30, 31, and then we move forward. And I would like to see Bitcoin get back into that 38, 40K range here. If the market rallies, that's where you could see BTC going. And if you load up BTC shorts, you'll notice that the big whales that were all negative on the markets have been reducing their positions throughout really all of this structure. So they've been dumping and getting rid of their shorts and moving towards the longs. And that's exactly what's really occurring in this market. Follow the whales usually helps you a bit. Ethereum, alts, not doing anywhere near as well. Notice Bitcoin leads this market. I don't think anybody that trades crypto doesn't know that now, but people seem to forget it. And they jump into alts too early. Ethereum isn't even showing that it's showing strength yet. I mean, yes, it's rallied, but it hasn't outperformed. And a good way of loading this up is to go, ETH/BTC or something like that, putting that on a chart and seeing where the ratio is. And if the ratio is strong and it makes sense and it's turning around like we saw when we were back in previous levels, and I remember we had a really good ratio that we were going through here back in October and back recently, that's when you want to get involved in this Ethereum market. At this stage, it's all about Bitcoin and its strength showing. If you haven't already, come and join us in our Discord community, and of course, come and follow us on FX Evolution on Twitter. And for the news ahead, remember, this is still a big week of news. We've just had a bunch of information come out from the Fed, though I'm not too interested in it in terms of their meetings. And then we have ISM manufacturing PMI 10 a.m. Wednesday before the open. JOLTS job openings. This is again New York time. And if we scroll down here, we've got non-farm employment change. This is ADP number. Usually this means nothing and it's false news, but still that's coming out 8:15. And we have the big one down here, which is the non-farm employment change in general, the unemployment numbers for the US. It's often widely considered the number one most important bit of information that comes out of the US market. At the moment, the Fed is very important. This is technically lagging, but it's becoming the number one. So what have we just seen in the economy so far? Jobs unemployment shortage, everyone's suddenly employed. What do we expect in the future? Well, I think it's very clear that we expect businesses to start doing layoffs. So let's find out when that starts to come through. But the numbers, this number in particular, will be the one that gets watched the most, and everyone will start talking about it in a few months' time, if not even already, because they're going to be looking for layoffs in businesses. And that's why we need to focus on this number. Lots of volatility and lots of dangerous traps there if you don't know what you're doing. So be careful there, guys. Thanks so much for watching. We hope you enjoyed the video. If you did, please subscribe, smash that like button, and thanks so much for getting us where we are right now. We're above 90. I've got to say thank you. We're getting close to the 100, and if you can get us there, you know what? That would be amazing. Thanks so much. See you in the next one. Bye for now.